Last week, the European Central Bank paid out almost €530 billion in low-interest loans. While most experts agree this was a necessary move, I'm joined today by Dr. Frank Hollenbeck to discuss the downsides of this move. Hi, Dr. Frank, welcome back.
Hello.
I'd like to start first with a quote from Freud. "Illusions commend themselves to us because they save us pain and allow us to enjoy pleasure instead. We must therefore accept it without complaint when they sometimes collide with a bit of reality, against which they are dashed to pieces." What does this mean in terms of the ECB loans?
Well, this is basically saying is we shouldn't be kicking the can down the road. My biggest fear with this LTRO that the ECB has been undertaking is that the unintended consequences of its actions, just like the unintended consequences of the Federal Reserve policy, which was to avoid a recession in 2001, and that caused a housing bubble and a crash of 2008. Let me just identify some of the unintended consequences of the ECB's actions. The first one is that it steepened the yield curve. In other words, what we have is long-term rates are still quite high, while short-term rates are much lower than they were before. This is inducing governments to borrow short-term, which means that in the future, if they continue doing that, it will be much more difficult for them to default indirectly by printing money. They'll be forced more to default directly, and that's because of what is called rollover risk. Okay, I talked about this actually in an interview back in December. The second risk has to do with what was happening in December. What we have in Europe is a situation where we have a lot of banks have toxic assets. For example, in Spain, we have a lot of banks have on their books housing loans. And if they were to mark to market, which means that if they had to actually evaluate those loans at their real market value, a lot of those banks would be bankrupt. And what we were seeing in December is we were seeing a lot of banks start to sell off some of those toxic assets and take the losses that would have been implied by writing down those assets. And what happened when the central bank came in with this basically free money, a lot of banks just said, oh, we can kick the can down the road. So we're going from a situation where we have banks with a lot of toxic assets to banks that I would call just zombie banks now, because they're still holding a lot of worthless assets, and they're just depending on the ECB for their current financing. So that's the second unintended consequences of the ECB action. The third unintended consequence is that we're seeing more and more of domestic government debt is being picked up by domestic banks. What's happening is a lot of foreign banks are pulling out their money. For example, French banks that have deposits in Italy, they're pulling their money out and it's being replaced with ECB money. At the same time, we have governments using moral suasion to force domestic banks to purchase domestic government bonds. So what we're seeing is that we're seeing more and more a lot of the financing, government financing coming from domestic banks. Why didn't we let Greece default? Okay. The reason we didn't let Greece default is because a lot of German banks and French banks were actually holding Greek debt. Okay. And the first 100 billion euro bailout for Greece was essentially to buy time. In other words, to give the German banks and the French banks time to basically write off this Greek debt. Let's look at the second bailout. The second bailout of 130 billion euros, 100 billion of that is going to go directly to German and French and other European banks. Okay, let's be very clear. It's not to help the Greek people. It's really to help those who are holding Greek debt. Now, what would have happened is that if Greek debt had only been held by Greek banks, my guess is that we would have let Greece default 2 years or back in 2010. Okay, I doubt that we would have pushed this concept of we have to keep the euro sacrosanct, we have to protect the euro sacrosanct. And my feeling is that if we have the same situation occur in Spain and Italy, it's going to be a lot easier for countries like France and Germany to just simply say, okay, well, you can go back to your local currency, because they won't have the direct effect on their particular economies. Okay. In the case of Greece, I still think that they should default. They should default. It would have been much better that we had used this 100 billion euros to help Greece. Once it had defaulted. Let's be honest. The situation in Greece is such that if you're young and you're talented and you have a little bit of money, you're not going to stay in Greece. In other words, there is simply no end. There's no light to the end of the tunnel in Greece. And what they really need to do is they need to default. Maybe they need to cut tax rates to make a foreign investment very attractive to invest in Greece. Default and going back to the drachma doesn't necessarily mean that the drachma has to be significantly devalued against the euro. Right now, Greece is in a situation where if you take out the interest payment and you take out the principal payment on its debt, it's not that far from a balanced budget. So Greece could do other things. For example, it could denationalize, I should say, a lot of industries by just giving it away. For example, just giving it to the employees, for example. In other words, there are drastic actions Greece could do to, within a year or two, get back on the right path, the path of growth. For example, a devaluation of the drachma could raise tourism. Right now, tourism is 15% of the industry. It could go to 25%. But we have to have some type of light at the end of the tunnel. And in the case of Greece, that's just not occurring right now.
Sometimes these unwanted side effects can outweigh the actual desired outcome. Do you think this could be the case with the ECB loans?
Well, it was the case with the U.S. central bank, in the sense that they tried to avoid a recession in 2001, and it led to an even worse recession in 2008. Right now, the ECB is getting away with it, in the sense that what's happening is we have a lot of money being pulled out of the system. For example, the Greeks have pulled out 70 billion euros out of Greek banks. But we also seeing the same thing in Italy and in Spain and in other areas. We also have banks contracting their loans, so that's also having a negative impact on the money supply. So what we have is we have banks and the public pulling money out, and the central bank pulling money in. But even though the public and banks have pulled money out, it doesn't mean it's disappeared. So the big fear is what happens when things get back to normal. We have tons of examples of hyperinflation, in the sense that you get an initial rush, just like when you have drugs, you have an initial rush and then you pay the consequences later on. And that's what I'm afraid of. What's happening right at the moment is that we're saying, oh, what the central bank is great, it's reduced the liquidity risk, it's reduced interest rates on government debt, so everybody is euphoric at the moment. The problem is what happens when we have all this money in the system sloshing around. What will happen when things get back to normal? What will happen in 3 years when these zombie banks, which will remain zombie banks, just like they did in Japan, what happens when they have to pay this money back? And that's the real issue.
From the last rounds of the loans in December, we saw a lot of banks using the money to invest in short-term government bonds. If we see that again with this round of loans, yes, it's helping in the immediate term, but 3 years down the line, are we back to square one?
You're right, in the sense that a bit like a drug addict who gets a shot of drugs, you get an initial euphoric impact of monetary easing. I can give you numerous examples where the initial impact of monetary easing is to get this euphoric feeling, and then you have to pay the price down the road, which is called hyperinflation. At the moment, the central bank is lucky. It's basically we are in a situation where people are pulling money out of banks. For example, in the case of Greece, they pulled out 70 billion euros out of their banking system. We're seeing the same thing in Spain, we're seeing the same thing in Italy, and we also have a situation where banks are also leading to a contraction of the money supply. So as banks and the public are reducing the money supply, the ECB is putting the money back in. The problem is what happens down the road when we have to realize the money that's been taken out hasn't disappeared. What happens down the road when we get back to normal and this money is put back into the system? Will the ECB be able to pull the money back out? See, that was a problem we had in the United States, is that they weren't able to pull the money back out that they put into the system in 2001 fast enough, and it led to the bubble and to the crash, in the sense that politically it was very difficult for them to it was easy to put the money into the system, much more difficult to pull the money back out.
Finally, Mario Draghi. He's well liked, and what he's been doing so far has been well received. If you're in his position, what's your next move?
You're right, it's been very well received by the financial press, which depends on banks. Mitt Romney said that corporations are people, governments are also people. And what the central bank is doing is it's taxpayers' money that's going to banks, that is being lent at 1%, so that banks can lend it back to taxpayers at 4%, and therefore they make a 3% profit. And that's going to lead to relatively large bonuses for people who work in the financial sector. We have a situation where the central bank is what I call a reverse Robin Hood, in the sense that it's taking from the poor to give to the rich. Every euro that the central bank prints is a tax on the money in people's pockets. And for me, central banking is reproachable. It's morally reproachable. If I had a scale, I would put pimps, drug dealers, and central bankers. So when you're saying is if I was Mario Draghi, what I would do is I probably would work toward the end of my job, and that's probably what I would do.
Dr. Frank, thought-provoking answers there as ever. If you want to see more interviews just like this one, stay tuned to Dukascopy TV.